Hello everyone and good afternoon. Welcome back to Crack Grade B. So this is going to be a short lecture on how to prepare financial statement. Few of you have asked for it that we want to see that how vertical profit and loss statement and vertical balance sheet is prepared. So I'm going to discuss the format with you. Apart from that, I'm going to discuss each and every line item with you, that what we represent in those particular financial statements. Right? Good afternoon. So let's start with it, and I will try to keep that crisp, and we'll not discuss unnecessary things which are not important from your exam perspective. All those people, you can discuss, you can see this particular lecture as the enhancement, as well as how you are going to prepare your P&L, as well as the balance sheet formats, what are the line items in it, and what is the meaning of those particular line items. So let's discuss this. First of all, we have statement of profit and loss. So earlier what used to happen was there was two bifurcations while determining the profit and loss. But first let's discuss one more thing. What I would like to tell you is, see, so before discussing the formats, I would like to tell you that P&L and balance sheet, this might be very non-useful information for all those people who are from commerce background, but for others, they might know it, they might not know it. So what is the duration of preparation for these financial statements? So whenever I am going to prepare the profit and loss statement, I prepare it from 1st April till 31st March. That means all the transactions, whatever has happened between 1st April and 31st March, I am going to record into my profit and loss statement. After that, one more thing which I would like to tell you, what I record in it. I record income, and then I also record expenses. Expenses which I have incurred in order to earn this particular income. So income less expenses, this is going to give you your profit or loss, whatever the situation might be. So what you have to figure out is this particular thing, that profit and loss statement is always prepared for the period of, that means for a period of 1 year. If your enterprise has started late into the year, that means you have established a new enterprise and you have established a new business on 1st October. Then your P&L statement will be prepared from 1st October till 31st March, right? Next thing, talking about the balance sheet. Balance sheet is prepared as on date. As on date. That means this is prepared at the end of financial year. What is my financial position at the end of financial year? So all the businesses which are operating right now, they are going to prepare their balance sheet as on 31st March 2023. That means on this particular date, what is the balance of assets and what is the balance of liabilities. This is the purpose of your balance sheet. Now we are clear with the durations, that okay, P&L statement is prepared for a whole period. Whatever income you have earned from 1st April till 31st March, this is going to be recorded into your P&L statement. Next, for balance sheet, this is going to prepared as on date. On 31st March 2023, on that date, what is your asset, what are your liabilities, that we are going to decide and we are going to record in the balance sheet. Now quickly moving to the format or how P&L statement is prepared. We'll be discussing all these line items in detail as well, although not much detail is required for you, but still having a basic idea is always important. So statement of profit and loss, you are going to write the name of the company, then profit and loss for the year ended. Here you are going to report the current reporting period items as well as the previous reporting figures. Why this is important? See, this is important for the comparison. For the same head, what was the earning for last year and what is the amount for current year? So this gives you a perspective, hence this is included over here. Same thing you will see in the balance sheet as well. This was not present in the horizontal format which we were studying, right? In the horizontal format, we always talked about current year. There was no mention of previous year, but with the amendments, with the changes, previous year has also been given a space in order to establish a, what you can say, your comparison. Number 1. So earlier what used to happen was there were two statements needed to be prepared in order to arrive at profit. One was your trading account and next is your profit and loss account. What we used to record in trading account was sales, purchase, opening stock, closing stock, and then your any kind of direct expenses. Result of trading account gave us gross profit. After determining the gross profit, we used to move at profit and loss statement. In profit and loss statement, we used to write gross profit, then we accounted all the incomes, all the expenses, and finally we arrived at net profit. So now this totally has been combined into one statement only called as the P&L statement. Number 1 item of this is revenue from operations. Whatever kind of business you are doing, suppose if you are into the manufacturing of biscuits, then you are going to earn revenue from selling biscuits. Your one biscuit retails for 20 rupees. So the customer gives you 20 rupees. That is my revenue. I cannot say that that is my profit because in those 20 rupees, I have incurred 15 rupees worth of expenses as well to earn that particular revenue. So always understand that there is a difference between revenue and the profit. Profit is what you get after deducting all the expenses, and revenue is the amount that you get from your customer without any deduction of expenses. So revenue of operation shows that what is the amount of revenue you have earned by your business. There is no rocket science in it. Next, other income. See, apart from the main business, you could also earn some ancillary incomes. A very great example is this. Suppose you are operating a factory, right? You have a factory of biscuits and you are manufacturing biscuits. You have got certain extra cash. So what you did was you purchased shares of Tata. Shares of Tata is an investment for you. I am going to show this particular investment into my balance sheet, but I am going to receive dividend every year from this particular investment. Whatever I have invested in the shares of Tata, I am going to receive dividend. So the dividend which I am going to receive is my other income. Why it is my other income? Because doing investments into different businesses is not my core activity. So revenue from operations is what you earn from the core activity, right? And other income is that you earn from the ancillaries investments that you have made. Suppose you have given some amount on as a loan to your friend. Your friend is paying you the interest. So that interest is your other income, right? So this is the concept. We have covered the revenue part. This totals to total revenue. Next item is your expenses. What are my expenses? These are total heads of expenses that I am going to discuss. So cost of material consumed, number 1. Purchase of stock in trade, changes in the inventory of finished goods WIP, employee benefit expenses, finance cost, depreciation and amortization, as well as the other expenses. Now, there is a rule over here. What is the rule? See, if you will see, I have mentioned just 6 specific heads. All the other expenses I have amalgamated or submerged into just one heading, that is other expenses. This was not the case in the horizontal P&L. What we used to do over here, for every expense we used to write a line item, right? But here they are saying that okay, this is the specific heads that we have provided to you. Apart from it, if you think that any expense, if it exceeds 1% of the revenue or 1 lakh rupees, whichever is higher. I repeat myself, right now I have just provided 6 specific heads of expenditure. You can add any other expenditure head as well in your format if that particular expense accounts for 1% of the revenue, more than 1% of the revenue, or 1 lakh rupees, whichever is higher. So you can write an separate head for that. Now discussing one by one everything. Cost of material consumed, purchases of stock in trade, material consumption. This is first discuss changes in inventories. So change in inventories is the difference between opening stock and closing stock, right? Purchase, whatever amount of purchases you have made. Now remember these particular thing, that either these two will come or this will come. Cost of materials consumed. This is also what? This is your opening plus purchases less closing. What did I say? That means either line item 1 will appear or line item 2 or 3 together will appear. You will mention only one of them. Just make me a separate line for them. The point of saying over here is either you will mention this or you will mention this. Both of them together will not be mentioned. Only one of them will be mentioned. Why? Because meaning of both of them is same. Changes in inventory is opening stock less closing stock, right? Purchases and cost of material consumed is also opening plus purchases less closing. Why this is being given over here like this? This differentiation has been made on account of, see, few entities are manufacturing units. Manufacturing units where actual production is happening, and few units are trading units. Trading units means where no manufacture is happening, they are just purchasing the stock and selling it. Right? So hence, if you are a manufacturing unit, you are going to show the consumption, and if you are a trading unit, then you are going to depict the line items like this: purchase of stock, what was your opening stock and what was your closing stock. Is this clear to everyone, or shall I explain it more? The point of saying over here is that in case of manufacturing unit, if you are having a manufacturing unit, then your statement will be represented like cost of material consumed, then directly your employee, finance, depreciation, other expenses, and it will give you total expenses. And if you are a trading unit, then you will represent purchase of stock in trade, changes in inventories, employee benefit, finance, depreciation, and the other expenses. Clear? Okay, fine. Moving ahead. We have talked about it. Now next thing we are going to talk about the employee benefits expenses. Nothing to understand over here. Whatever you are going to pay to your employee, be it basic salary, be it DNS allowance, be it any gratuity or any other related expenses, provident fund related expenses, whatever you are going to pay to your employee is going to come here under employee benefit expenses. Next is, what is the finance cost? Every business runs on two kinds of funds. One is equity and the other one is debt. That means obviously in the course of business you are going to take some loan, you are going to pay interest on it, right? So this is your finance cost. The interest which you are paying on loans, you might have taken some loans. Apart from it, debenture interest, this is also a loan. So any kind of borrowing that you have made, if you are paying interest on it, that will come up under the finance cost heading. See, service sector mostly they'll get with the trading units only, because manufacturing there is a consumption of goods, but in case of service sector you are not predominantly dealing in the goods, but yes, in order to provide some services also you need some products, correct? So hence the service sector will also follow the format which has been there for the trading units. Next, see depreciation and amortization. So you have got fixed assets. Suppose you have purchased machinery for 10 lakhs and this machinery you are going to use for 10 years. So hence for each year 1 lakh depreciation is there. This is the book method. Apart from that, there is another method under income tax. Income tax says that 15% is the depreciation rate for your machinery. So I am going to apply that particular rate on my machinery, comes out to 1,50,000. So depreciation is the wear and tear that occurs because of the usage of fixed assets. Next is amortization. What does amortization means? So there is a term called as goodwill and the other intangible assets. This is just an example. So what does goodwill means? Goodwill can be a purchased one, goodwill can be a self-generated one. Goodwill means the reputation which your business have generated across all these years. Suppose you are operating a shop in a locality for past 15 years. So obviously a goodwill has been generated. Why? Because this particular goodwill you have generated over the years. Self-generated goodwills are not recorded, but purchased goodwills are recorded. Suppose your Facebook has purchases Instagram. This is just an example, don't go in the technicalities. So Instagram already had a reputation. If Facebook is paying more to Instagram, why Facebook is paying more to the Instagram? Because of the because Instagram is famous, because Instagram has got a trust, Instagram has got a goodwill. So if you have purchased the goodwill and you are going to amortize it over the years, that means you are not going to take the total expense in 1 year. You are going to charge that particular expense for let's say 10 years or 15 years or whatever the amount of time in which you are going to utilize that particular goodwill. Yeah, so depreciation and amortization means that. Now apart from that, any other expenses, they will come under this particular heading of other expenses. Now I have told you that you can create a different line item here as well if that particular expense is accounting 1% of your revenue or 1 lakh rupees, whichever is higher. If this is clear up to this point, we have talked about revenue, we have talked about expense as well. Revenue minus expense, it will give you the profit before exceptional and extraordinary items. Now, what are these exceptional and extraordinary items? Let's discuss that. So there are two items which I am going to talk about. First one is extraordinary, and then exceptional. It is important to understand the difference between both of them, because sometimes we do not understand the difference, and these particular terms have been used so many times in the accounting. So what does extraordinary means? Extraordinary means, very easy thing is there, which does not happen. First, let's talk about extraordinary only, which does not happen during the ordinary course of business. For example, I'm going to tell you, understand this particular thing. You can, extraordinary items, you can always remember it, that which is not ordinary. Now, what is an ordinary thing? Suppose you are a manufacturing entity, and as our standard example, you are making biscuits, right? Now, what is ordinary in this particular business setup? Selling biscuits is ordinary. Yes, we are going to do that on a regular basis. Ordering for raw materials from our supplier, that is also ordinary thing, we are going to do on daily basis. Hiring employees, firing employees, right? Means if you do not like the work of any kind of employee, you can fire them. This is an ordinary course of business. All of it is ordinary. Now what is extraordinary is, let me give you an example. Loss by fire. This does not happen during the normal course of business. Tell me, do you expect that there will be a fire in our business in every year? No, because this is extraordinary. Another example is sale of asset. You purchase the asset in order to use them into your business. If you are selling an asset, this is not an ordinary transaction in your business. This is an extraordinary item. So what your schedule 3 of profit and loss statement says, that any kind of extraordinary items or exceptional items, you have to show them separately. Why to show them separately? Because all the stakeholders who are watching the financial statements, they can have a separate eye on them, that okay, this is different and we have to pay more attention to it. Therefore, a separate disclosure has been required. So this was your extraordinary item. Now let's talk about the exceptional items. What are exceptional items? See, exceptional items, they happen in the ordinary course of business only. But sometimes the what you can say, the amount of it can go exceptional. For example, I'll tell you, mass layoff. Mass layoff means, see, hiring employees and removing employees from the job is the normal ordinary course of business. This particular activity you do on as a usual activity. That's why every entity has an HR department or human resource department. Now, exceptional item can be which is ordinary in nature, but because of the scale or the quantity or the amount, it has become exceptional, like mass layoff. So mass layoff, you are removing so many employees from your entity. This is why this particular item has become exceptional, right? So after understanding the meaning of exceptional and extraordinary items, go in there. So extraordinary item, profit before exceptional and extraordinary items and tax. We have calculated it. How? Income less expenses. Now if there are any exceptional items during the year into your business, please write the impact of it. Next, profit before, because see, if you have done mass layoff, then you have to pay some amount to your employees, right? You are removing your employees, so you have to pay an extra amount. What you had to pay normally, you have to pay an extra because you are removing them before time. You are removing them because of no mistake of theirs whatsoever. So you had to pay an extra amount, and that extra amount is your expense that you need to show here as an exceptional item. Next is profit before extraordinary items and taxes. Now because you have already written exceptional items, this particular thing has been deducted. Now if there is any extraordinary item into your business during the current year, please show in here. If there is any loss by fire, loss by theft or any other thing, then you will depict it over here. Now finally we have got our profit before tax. Now we have to show that what are my tax expenses. So there are two heads, current tax and deferred tax. Current tax is whatever your tax liability that you have arrived at. What is deferred tax? So see, what happens is, I'll tell you an example. See, so deferred tax concept, there are many technicalities if you go into the detail, but let's just talk in very simple terms. So whenever you prepare financial statements, we prepare our financial statements as per Companies Act. But income tax, whenever you have to pay income tax, you have to follow the rules and regulations which have been given under Income Tax Act 1961. There is not much difference, but few differences occur on account of your preparation and how Income Tax Act interprets it. For example, one example is your depreciation calculation. Wait. Like you prepare as per Companies Act, you follow accounting standards, right? Accounting standards and Income Tax Act, sometimes they differ on various aspects. One good example of it is calculation of depreciation. Income Tax Act says that please calculate depreciation. Percentages are already given in Income Tax Act and you have to calculate them on WDV basis. WDV basis is written down value method. And as per Companies Act, you can calculate depreciation on the basis of straight line method as well. I am hoping that you already know the difference between straight line method and your WDV method. I hope that you know it. If you don't, some of you, if you do not know it, please tell me in the comment section, because I have covered it while I was discussing the accounts related lectures. So even if you have not seen it, please tell me in the comment section. So these are the differences which occur. So finally, what I am trying to tell you is the profit which you have calculated might differ with the profit on which income tax is levied on you. So therefore, deferred tax arises. Deferred tax is the difference that you have calculated tax liability how, and income tax department, or as per the Income Tax Act, what your tax liability has been arrived at. This is called as the deferred tax. So current tax that you have given, that is an understood item. After that, deferred tax is also written in case any difference is arising between your tax calculation and Income Tax Act related calculation, then that difference you are going to write under deferred tax. Is that clear? Next thing, I have deducted my current tax as well as deferred tax. After that, I have arrived at profit and loss for the period from continuing operations. You can also incur profit or loss from the discontinuing operation. Discontinuing operation means there might be a business which you have closed, but any profit might arise from that particular business, or someone has asked that you have not paid this particular liability of mine and it related to your closed business, so you have to pay that liability. So any expense can also arise. So both of the situations can arise with a closed business. So if you have any kind of profit or loss from a discontinued business, you are going to show it over here. Next, tax expense of any discontinuing operation, if there is any. Finally, you have got your profit or loss after you've got your profit and loss for the period. How you have got profit or loss for the period? The profit and loss what you have calculated for the business which you are carrying currently, and profit and loss from the discontinued business as well. You will add both of them and you will get your profit and loss for the period. So if some of you do not know about the methods of depreciation charges, then I'll recommend you please watch the accounting related lectures of mine. Right? Finally, we have reached to earnings per equity share. There are two concepts, basic and the diluted. Earning per equity share is the EPS, which you have to show into your P&L statement. Now let's see how this is calculated. First, I am going to tell you how basic EPS is calculated. So, basic EPS is equals to the profit after tax, final profit that we have arrived at. Profit after tax divided by number of shares that your company has issued. For example, see, profit after tax is 1 lakh rupees. For example, we have earned this much profit and we have already issued 10,000 shares, means there are 10,000 shares in my company. So everyone who is holding at least a share, how much amount he is going to earn? 10 rupees. So this is my basic EPS. Here I want to tell you, or here the report wants to tell the shareholders and as well as other stakeholders that for every share we are giving an earning of 10 rupees. Right? So this is your basic EPS. Now we are going to talk about the diluted EPS. See, diluted EPS. Diluted EPS is an extension of your basic EPS only. What happens in diluted EPS is, see, if you have issued convertible debentures. What are convertible debentures? Suppose I have said to someone that please give me 10 lakh rupees right now as debentures. That means I am going to pay you interest over the years. And at the time of maturity, that means at the end of 10 years, what you can do is you have got two options. Either you can take 10 lakh rupees from me in cash, or you can convert that 10 lakh rupees into shares. This is called convertible debentures. That means these debentures at the end of maturity or at the time of maturity, these debentures will get converted into equity shares. So diluted EPS takes the impact of these shares as well. See over here. The formula remains the same. Suppose I have earned 1 lakh rupees. There is a formula for it, specific formula for it, but we are understanding it a bit easier terms. 10,000 shares are already issued by your company. These are your existing equity shareholders, and you are estimating that if those debentures will be converted into equity shares, then they will account for 5,000 shares. They will account for 5,000 shares. Now, once you will convert those particular shares, you will also have an addition over here. What kind of addition over here? See, till now you were paying interest to those debenture holders, but once those debenture holders will convert their debentures into equity shares, you will be no longer have to pay interest to them, right? So interest amount will get added on over here. Let's not make it technical, just write that you will be having savings here. What kind of savings you will be having over here? You will not have to pay certain amount in form of your interest to the debenture holders. So some amount of savings will occur to you. So 1,20,000 divided by 15,000. This will be your diluted EPS. I do not have my calculator with me right now. Please calculate it for me. So 120 divided by 15. Right? So 8 rupees is my diluted EPS. Yes. So 8 rupees is my diluted EPS. See, basic EPS is 10 and diluted EPS is 8. Now the point I am going to tell you over here is that diluted EPS always remains lesser than your basic EPS. This is the line which you should remember. What did I say? Diluted EPS always remains lesser than your basic EPS. So please understand both of these. Nobody is going to ask you that please calculate diluted EPS. Nobody is going to ask you. But what I have told you is please just understand the concept over here. Basic EPS means what is going on currently, and diluted EPS means you might be having some convertible debentures, some convertible preference shares with you. So if those debentures or preference shareholders get converted, then what will be the impact on your earning per share? This is called as diluted EPS. This is very simple. Suppose right now we are 10 people here. We are taking all the earnings for ourselves. Suppose 5 people more, they come into our group. Now earning will get distributed among 15 people. As soon as your numbers of people will increase, your earning will decrease only. Per share, the earning is going to decrease. Hence, this is called as the diluted EPS. So with this, we have completed your P&L statement. Now quickly moving to the balance sheet. I have included the descriptions of all the line items that I have explained to you over here. You can read it on your own. I have explained all of them to you, so do not worry. That is just for a reading purpose that I have provided to you. Now going to talk about the form of balance sheet. This is super easy. So see over here, form of balance sheet, name of the company, figures of current reporting period, figures of previous reporting period, same thing. Now we are going to talk about this vertical balance sheet starts with the equity and liabilities. Same as horizontal format, there is one section of equity and liabilities and then we are going to reach your assets. Both the balances should match. That means the total of your equity and liability should match with the total of assets. Why do I yes, you can. So what is the difference between equity and liability? Can anyone tell me that why do I put equity in the liabilities column? So my question is, this is how my balance sheet looks like, right? This is the liabilities section. And then we've got a assets section, right? Why do I write equity in the liabilities column? Why? Why I club equity with the liabilities column? This is my question and you have to answer this question while I'll tell you that what all is there. So see, equity, first item is your, in equity and liability, first item is your shareholders fund. What all is there in shareholder fund? Number one, share capital, right? What the amount you have invested in form of your equity share capital, preference share capital, that is going to be reflected over here. The amount of money which investors have given you, investors have subscribed to the share capital of yours, you are going to write in the share capital. Next one is reserves and surplus. Reserves and surplus, you are going to show your general reserve, profit and loss statement balance, that means whatever profit you have earned. After that, revaluation reserve or any other kind of reserve and surplus that you have is going to be reflected under reserves and surplus heading. Next heading is money received against share warrants. So what happens is companies issue share warrants. What are these share warrants? So anyone who is going to purchase this share warrant, he'll get a right to purchase shares of company in future at specific price. So what does it mean? Suppose if I purchase share warrant of Tata for 50 rupees, that means in future I can purchase shares of Tata at specified price of 500 rupees. So this is the meaning of share warrant. So whatever amount you have received from the investors in form of share warrant, that is you are going to reflect over here. Money received against share warrants. Understood this? Very good, Nivedita. So answer is this. Why equity is shown is the liability side? Because business and owner are two separate things, right? So amount has been invested by the owner and business remains indebted towards the owner. So equity is also a liability for the business. This liability business have to pay to whom? To owner. So I hope that you have understood the first thing, that is share. Yeah. So In this particular case, what happens is, suppose you have called for application, but still you have not made the allotment, right? Means you have not decided to whom you are going to allot the shares. So this is why, for the meanwhile, whatever amount is pending with you, you are going to put here, share application money pending allotment. Next, non-current liabilities. Non-current liabilities are those which are going to remain into your business for a period of more than a year. What can be items under it? Long-term borrowing, like your debentures, bank loans, if you have taken for a period of more than a year. DTL is deferred tax liability. Suppose the tax amount which you have calculated is less, but the government is asking for more, then obviously your liability has arisen, because you have to pay whatever the amount government is asking. So you will write it in the deferred tax liability. And suppose the opposite of it, if you have paid more than what was required, so in that particular case, that will be called as deferred tax asset. That means you have paid in advance, and that will be shown on the asset side. Lastly, any other kind of long-term liability which you might be having. Next item here will be long-term provisions. So long-term provisions means if you can foresee a liability, that liability is going to be last more than a year, and you are protecting some amount for it, you are keeping some amount for it in form of provision, then that is called as a long-term provision. And finally, the fourth item is your current liability. All those liabilities which are going to be consumed or going to be paid off within a year. Short-term borrowings, trade payables. Trade payables means, suppose you are a manufacturer of biscuit and you have purchased maida. So maida supplier is a supplier for you. He is providing raw material and other kinds of stuff in order to carry out your business, hence called as trade payables. Other current liabilities and short-term provisions. Other current liabilities can be, suppose you have to pay the dividend. Dividend payment has to be made within a year. So this is your other current liability. Short-term provision can be tax related provisions, because whatever amount we have calculated or whatever the provision which we have made, we know that we have to make the tax payment within a year. So in short-term provisions, your tax provisions can come. Other current liabilities, like you have not paid electricity bill. Electricity bill is outstanding, rent is outstanding, employee's salary is outstanding. All these expenses you need to clear within a period of 1 year. Hence, I will club them in my current liabilities. Moving on to the assets. Assets are having just two classifications. Number one classification is non-current assets, the assets which are going to be used by you over a period of more than a period of 1 year. Number one, fixed assets. You can have tangible assets as well as intangible assets, capital WIP, and intangible assets under development. So intangible assets under development means, suppose your any R&D related work is going on. You are working on a new technology. So this is intangible asset under development. Intangible assets can be your goodwill, patent, copyrights. So these are all your intangible assets. Tangible assets, machinery, land and building, furniture and fixtures, all those are my tangible assets. Tangible, intangible. Tangible assets are those assets which can be seen and touched. Intangible assets which are not in the existence. Patent, there is no existence of patent. This is just a document which verifies that you have got a patent. So these are all the things. Capital work in progress is, suppose what happens is, there is a completed unit and then we can differentiate with it. A completed machinery will be reflected in the tangible assets, but there is also machinery on which you are working. That machinery is under construction. That machinery is under development. So I will call it as the capital work in progress. The amount which you are incurring is a capital expenditure, but still it has not been completed. So this is called as the capital work in progress. Next we have got non-current investments. Suppose I have invested in the shares of Tata and I have the intention of holding these shares for a period of more than 1 year. So I will be classifying them into non-current investments. This depends on your intention. Any investment can be short term, can be long term, but depends on your intention whether you want to keep it for a long term period or short term period. Next, deferred tax assets. I told you if you have paid more than what was required, that means you will get a refund for it, or hence you will classify it into the deferred tax assets and you can use it for a future period. Long-term loans and advances that have been provided by you. So suppose there is a friend of mine who came to me and asked for a loan of 3 lakhs for a period of 2 years. I gave a loan to him. Now this is my asset. Loan has been provided by me and hence I will classify it into my assets in form of long-term loans and advances. And finally, any other kind of non-current assets that you might be having, you can write it over here. Moving to our second item, that is current assets. So current assets, number one thing is current investments. Current investment means any kind of investment that you aim to hold for a period of lesser than 1 year. So that will be classified under my current investment. Inventories are there. The stock in trade, also called as stock in trade. This is the stock which you are using on the daily basis to do sale and purchases in your business. Trade receivables are your debtors. These are the customers to whom you have sold your product and you are yet to receive the payment from them. Cash and cash equivalents, cash in hand, cash at bank. So this will be classified over here. Short-term loans and advances, and finally your other current assets. So this is your total of the balance sheet. We have discussed all the items in the P&L as well as all the items into your balance sheet. I hope that you now understand the format of how balance sheet and P&Ls are prepared and what are the items of it. When you'll get the hold of this PDF, please do give it a reading more depth. I have tried to include many things in here, all the descriptions, everything, you can go through it. So this is it, and if you've liked this lecture, please do not forget to like and share. Thank you so much for watching.